Good afternoon, everybody. Uneducated Economist here. So in this video, we are going to be talking about the ongoing liquidity crisis that we are seeing taking place within the banking system. Many people are talking about this, and you're finding a lot of YouTube videos referring to the mistakes of the Federal Reserve and how it is that they do not know what they are doing, and it's obvious that they have lost control when you see the secured overnight financing rate move above the effective fund rate. I know that's really confusing for a lot of people out there, and this stuff is not easy to process. And many times you need a very long video with lots of information in order to figure out what it is that's really taking place, and not everybody has the time to do that. So really, in this video, I just want to share two key points. And I don't know if you need to go and research this for yourself so that you can get a better understanding of it. But when it comes to understanding these two key points, I believe this is the culprit for the reasoning behind why it is that the SOFR had moved above the effective fund rate. So now when we think about this, the effective fund rate is the overnight lending rate between the big banks. This is what the Federal Reserve is attempting to target. Now, understanding that this is not the same as what it was, say, 6, 7, 8 years ago, prior to COVID, when we had a limited reserve system. So understanding that the limited reserve system gave the Federal Reserve the ability to set overnight or set interest rates by adjusting the reserve levels, right? The amount of reserves these big banks have. And if you have a limited reserve requirement, then the banks on the overnight lending would have to borrow from the banks who had excess reserves, and that overnight lending rate would be the effective fund rate, what it is that the Federal Reserve is targeting. I know that's really confusing for a lot of people to try and internalize, but it's important to understand that, because what ended up happening is during COVID and the quantitative easing is essentially what happened is the reserve requirement was eliminated and the banks were just overloaded with reserves. So we got the quantitative easing situation taking place, and these banks are then loaded up with reserves. We're seeing the now opposite effect taking place from the quantitative tightening. Now these reserve levels are dropping, and this is where people are saying, okay, the Fed screwed up. The liquidity crisis is now taking place on account of all this quantitative tightening, but they're not thinking of the two culprits. Right? The two culprits that are taking place inside of this is banking restriction at the balance sheet level, balance sheet constraints. This is like a shadow tightening that is taking place. Like, as they said, we're going to end the quantitative tightening, there was something else happening within the banking system that was not well discussed. Now, to understand what it is that's happening with these big banks is something called the supplement leverage ratio, SLR. Right? Now, the supplement leverage ratio, this requires the banks to hold capital against total assets, including low-risk treasuries, I'm reading on this, right, at a minimum 3 to 5% ratio. As quantitative tightening shrinks reserves and treasury issuance surge, needing dealer intermediation, SLR bound banks, right, this supplement leverage ratio, bound banks hesitant to warehouse more bonds and lend into the repo markets, pushing up SOFR as cash seekers bid higher. So now here it is, they have the supplement leverage ratio, and this requires banks to hold capital against total assets. So now, to understand the capital part of this whole balance sheet, you got assets and liabilities. Everybody understands how assets and liabilities work on a balance sheet, right? So you have your assets, all the, things like for us it's cash, for banks it's loans, but you understand that part. Liabilities is all the debts that you owe out there. So you got the balance sheet of the big banks. The capital is all the money they have beyond the assets. So if they took all their assets, sold them off, and paid off their liabilities, the capital is all the excess money that they have, right? That's the capital. These banks are required, right, to hold capital against total assets, including low-risk treasuries. So as they are expanding their balance sheet, or the idea of expanding the balance sheet then has a need for extra capital, right? And it's not extra capital, but capital beyond the or capital beyond that of the assets and liabilities in order to meet the requirement that they are asking of these big banks. Not asking, demanding. That's what I should say. Demanding of these big banks. So ultimately, that capital, right, if by deploying it into these, is requiring even more capital. So as they expand their balance sheet out there, it's requiring ever increasing amounts of more capital to hold. And this is a spot in which that, a lot of these banks are like, no, we don't want to do that. Right? And so this is one of the reasons why the SOFR is moving up, is because essentially the banks are like, no, I'm not buying into the SOFR right now. We're not expanding our balance sheet. Right? Because it has this capital requirement behind it. The other one, now I'm not saying that all banks are suffering that. I'm just saying that that could be one of the reasons why you're not seeing it. See, even like there's a great video, I'm going to leave it down in the description, to Jeffrey Snyder and Steve Van Meter, 20-minute interview. It's great. Go down there and check it out. But they don't bring up these two particular things. And that's something that I was listening for. I'm like, okay, guys, are you going to bring this up? Because I've been looking at this as one of the reasons that the SOFR rate has moved up above the effective fund rate. Everybody else says it's liquidity crisis and banks are like, scared and they don't know what to do and the Fed's screwed up and all this other stuff. And I'm thinking, I think it's more regulatory than what people are realizing, because this isn't brought up. Like no articles, no other people are talking about these two particular things. Now, that was supplement leverage ratio. That's the first one. The other one is liquidity coverage ratio. Now, this one is a lot more popular, and people are probably heard about this one a lot more than, say, the supplement leverage ratio. But the liquidity leverage ratio says this: banks must stockpile high-quality liquid assets, that they also refer to it as HQLA, like reserves or treasuries, to cover 30 days of outflows, 100% coverage minimum. So to understand that, they are essentially put into a position in which that they are required to hold a particular amount of high-quality liquidable assets. And in that sense, right, with reserves down and the quantitative tightening accelerating the drain, LCR floors force defensive plays, hoarding cash over lending it out in repos, which directly inflates the SOFR, right, the secured overnight financing rate, while the effective fund rate stays anchored low. So these are two definite reasons that it could be taking place within the financial markets right now, and the reasonings why you're watching these SOFR move up above the effective fund rate. Now, if, like, again, this may happen again, it may go back to normal, but to me, this isn't an operation of failure or liquidity crisis, but this is one of bank regulatory issues that not a lot of people are discussing. And so again, when we think about these two limitations within the banking system, they're like looking at it saying, we have a capital requirement that if we expand our balance sheet, it's going to require ever increasing amounts of more capital from us. No, thank you. We don't really want to go that route. That makes sense, right? And if they do say, hey, man, we're going to go that route, we want a bigger return on the SOFR because it's going to require more capital from us to take that on. You see? And then the other one is the liquidity coverage ratio, which again is the bank's stockpiling of high-quality liquid assets, being close to cash, needing to be close to cash in these treasuries to cover the 30 days of outflows 100%. With reserves down and quantitative easing accelerating the drain, LCR floors force defensive plays, hoarding cash over lending it out in repos, which directly inflates the SOFR while the effective fund rate stays anchored low. Now, I don't know how many other people are going to be able to recognize that as the situation that is now taking place. But when I just step back for just a minute and I just say, okay, wait a minute, this stuff is way complicated. Like, even for me, like trying to really internalize this completely, I even wonder sometimes, like I read it over and over again, read all kinds of stuff coming from the Federal Reserve. And even I'm still like thinking, okay, am I really grasping this correctly? Right? But when I think about what it is that's happening right now within the whole economy and the perception that people have of what it is that's taking place. Now, here you have a Federal Reserve that says, hey, we're lowering interest rates, or we have been lowering interest rates, or we lowered interest rates. That idea was presented to the markets. Markets ran with that idea. But the reality of the situation, something different has occurred. So now, okay, we have the Federal Reserve saying, hey, we just lowered rates. But then the banking system's going, yeah, I don't know, man. The SOFR's up above the effective fund rate. That's the banks like hoarding on the cash, not wanting to lend it out there, all nervous about each other. So we have a tightening within the financial system, even though at the same time the Federal Reserve declared that they were easing the monetary policy. It wasn't necessarily easing, less restriction, right? But they're saying, hey, we're backing off on the restriction of the monetary policy, which is essentially an easing effect. But we saw the exact opposite happen within the banking system, and that's evident within the SOFR, and this is where people lost control of the idea, or they got the idea that the Fed lost control. Now, think about this for just a minute. They have two problems. The dual mandate. Low inflation with stable prices, somewhere around 2% targeting. Whatever the hell that means, right? Low inflation with stable prices, somewhere around 2%. Again, I kind of question whether or not that's even a possible, that's a pipe dream of all pipe dreams. But anyway, that's what they say that they're trying to do. The other mandate is full employment. Or I guess way a lot of other people will say it, no layoffs, right? No, I'm just kidding. Full employment, like that's everybody working. If they want a job, they can have a job. That's, I don't know how you want to describe it. Unemployment runs rampant through this economy, and yet here it is, we have historically low unemployment. So it's not like you can necessarily trust the numbers, because they obviously don't seem to portray what it is that we are witnessing out there for ourselves in reality. But when it comes to the monetary policy and how it is that they conduct themselves, this is essentially it. Those are the two mandates. Low inflation, stable prices, somewhere around 2%, and full employment. Now, how is it that you are going to deal with an economy that has inflation that seems to be persistently high? At the same time, you got the unemployment rising. Now, this is a dual, right? Like the dual mandate is now dueling, right? And so what is it that the Federal Reserve is supposed to do? One, support the unemployment, right? Make sure that people have a job. So if you lower interest rates, people will go out there and borrow the money. And by borrowing the money, all this economic stimulus and activity happens, and then people go to work. Okay, so simple as that. It's deeper, it's more complicated, but whatever. That's easy enough to understand. Lower interest rates, people go to work. Now, at the same time, if you lower interest rates, the idea that it's going to cause inflation, which is exactly the opposite of what it is that the Federal Reserve is attempting to do with their dual mandate. So you got these two battles that they're fighting. What is it that they could possibly do? But what is it that's happening? Here it is. They declared that they lowered interest rates. The effective fund rate went down, but yet the financial system tightened. We're supporting unemployment. We have to lower rates. We have no other choice. This interest rate's got to come down in order to support the labor market. We can't let the labor market get out of control. Labor market, interest rates going down, labor market. And that's all you hear out there. But then the reality of the situation is we have this liquidity tightening, issues taking place. People are pointing their finger at the big banks saying they're pissed, they're losing control, they don't trust each other. But yet really, deep down in the workings of the banking system itself is this monetary constraint that is happening within the financial systems itself, which is creating a tightening effect, a shadow tightening effect, which is essentially trying to keep the inflationary pressures down. You see how they were able to achieve this? See, the only way I'm able to actually call this stuff out is because of the credible threat theory that I have developed over the last few years. This is the type of stuff that I look for. Most people don't even know to look for this kind of thing. And I'm thinking to myself, nah, man, this more has to do with perception. And then there's a reality to the situation. What are those two different things? Can we look at it as two different things? There's a reality. Here we got the supplement leverage ratio, right, which is requiring the banks to have capital on hand exceeding that of their assets and liabilities. And if they expand the balance sheet, they have to expand the capital, which is something that they're not necessarily wanting to do right now unless they get a bigger return. Makes sense why the SOFR would go up if that's the situation. Right? And the same thing with the liquidity coverage ratio, which is, again, how do they describe it? Because this one, I think, is probably more in line with what it is that's probably taking place out there in the general view of the big banking system, is that with the reserves down in quantitative... Okay, hold on. Liquidity coverage ratio, LCR, banks must stockpile high-quality liquid assets, HQLA, like reserves or treasury to cover 30 days of cash flow, 100% coverage minimum. With reserves down and quantitative tightening accelerating the drain, LCR floors force defensive plays, hoarding cash over lending it out in repos. This is the result of that, which directly inflates the SOFR while the EFR stays anchored lower. So, to me, like, that makes so much more sense than what it is that people are screaming out there as far as liquidity crisis. Now, I'm not saying there ain't going to be a liquidity crisis, but when you think about statements coming from, like Janet Yellen saying that she doesn't think that we'll ever have another financial crisis in our lifetime, stuff like this starts to really make a lot of sense, right? That they have regulated the banking system and the shadow tightening system in which that they can combat the inflationary scenario while at the same time directing a propagandized information mainstream media into believing that they are trying to support the labor market. Uneducated Economist. You guys let me know.